the Minda Limited Q3 and 9 months FY25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sunil Bohra, Group Chief Financial Officer, for his opening remarks. Thank you, and over to you, sir.
Thanks, Sagar. Good afternoon, everyone, and a warm welcome to all the participants. On the earnings call today, I am joined by my colleague, Ankur. We have uploaded our financial results and investor presentation for Q3 and 9 months FY25 on the stock exchanges and our company's website. We hope everybody had an opportunity to go through the same. I would like to begin by giving some insights on the economy, followed by the current scenario in the auto industry and our financial and operational performance for the quarter and 9 months. Post that, we will open the floor for Q&A. The global economy is projected to grow at 3.3% in both 2025 and 26, remains below historical average of 3.7%. The US continues to grow at 2.7% in 2025, driven by strong consumption and a resilient labor market. In contrast, the Euro geography seemed to be weighed down by weak manufacturing and geopolitical concerns. Despite fiscal support, China's growth is expected to remain at 4.6% in 2025 as property market challenges persist. Further, global outlook looks challenging due to trade and geopolitical risks. This may disrupt global supply chains, reduce investments, and delay growth prospects, particularly in trade-intensive sectors. The geopolitical scenario, including tension in the Middle East and some other provinces, remain unresolved. Meanwhile, emerging markets are showing mixed performance. India, on one hand, continues to shine, with growth holding steady at around 6.5%, supported by strong domestic economy. India's growth is expected to remain stable, with limited downside risks compared to some of the other emerging markets. This stability is a testament to the country's ability to navigate global headwinds, including potential trade policy uncertainty and geopolitical issues in some of the regions. In this uncertain environment, agility and strategic planning will be key. As a company, we must remain vigilant, adapt to changing conditions, and seize opportunities where they arise. Moving on to the automotive industry, for the quarter ending December 24, the Indian automobile industry demonstrated growth in Q3 FY25, achieving a steady year-on-year volume growth of approximately 7%, with total production reaching around 78 lakh units. This positive performance was largely driven by robust demand in the two-wheeler, whereas PV segment contributed with marginal growth. However, the commercial vehicle segment saw a decline in production as it is faced sluggish industrial activity and delayed government expenditure. In Q3 FY25, the passenger vehicle segment demonstrated production volumes growth of 3% year-on-year to reach 11.7 lakh units. The growth in passenger vehicle slowed a bit after a stellar last few years. Meanwhile, as per FADA, dealers anticipate strong consumer pull from new SUV launches, feature-rich EVs, and its maturing EV ecosystem, though price-sensitive buyers and interest rate fluctuations remain watch points. In Q3 FY25, the commercial vehicle sector experienced a modest decline of approximately 2%, reaching around 2.4 lakh units. This subdued performance was largely attributed to a slowdown in industrial activity, delayed government fund disbursement, and sluggish financing approvals, prompting many customers to defer purchases. However, optimism is building, particularly in regions benefiting from infrastructure projects. The sector is expected to see a gradual recovery, supported by an accelerated pace of infrastructure development and government incentives, which could drive fleet renewal and expansion. The two-wheeler segment delivered a solid year-on-year growth of approximately 8%, with production reaching around 59.2 lakh units. In contrast, the three-wheeler segment witnessed muted growth, reflecting broader market sluggishness. However, towards the end of the quarter, the two-wheeler segment experienced a month-on-month decline, primarily due to a delayed government fund releases and a stricter financing norm imposed by lenders. These factors dampened market momentum and had some impact on softness in demand. Despite these near-term challenges, the long-term outlook for two-wheeler and TV segment remains positive. Improved supply chains, new model launches, and strengthening rural demand are expected to provide a significant boost. Recently presented Union Budget 2025 is well balanced in terms of supporting India's aspirations of emerging as a global hub for tech and innovation, while supporting MSMEs, the nation's backbone, and creating more job opportunities for the nation's youth. The most newsworthy and important announcement is the increase in income tax exemption limit to 12 lakh. For consumers, this opens access to more disposable income, which has the potential to translate into increased spending and may have positive impact on automotive demand. Presenting the Union Budget 2025, the Finance Minister highlighted a strategic push for the EV industry, focusing on enhancing both supply and demand. The government's commitment to indigenous manufacturing is clear from substantial allocation of funds to various schemes like PM E-Drive, Auto PLI, and ACC PLI. Personal income tax relaxations aim to boost private consumption, complementing these supply-side measures. Customs reforms include exempting basic custom duty on lithium-ion battery scrap and critical minerals like lead, copper, etc., ensuring a steady supply for local production and job creation. To further support the EV sector, BCD exemptions have been granted to additional capital goods to bolster lithium-ion battery production. Overall, the budget was encouraging for the industry and likely to support medium to long-term growth of the industry. Before we delve into our financial and operational performance, I would like to highlight about our impressive showcase of innovative technologies and solutions at the recently concluded Auto Expo Component Show 2025. We highlighted our commitment to personalized, autonomous, connected, and electrical mobility solutions. We had a dedicated green mobility zone featuring 3 technology demonstrators: TD125 electric skateboard, TD425 electric bus, and TD225 electric bike, highlighting cutting-edge product portfolio for E2-wheeler, E3-wheeler, and E4-wheeler specific solutions as well. In that zone, we unveiled state-of-the-art products like highly integrated e-axles, intelligent battery management systems, dual charging capability, and seamless connectivity, all designed to redefine the electric mobility experience. Our advanced lighting solutions included connected pixel-based digital tail lamps, OLED lamps, and adaptive lighting. Personalized and smart innovations featured augmented reality heads-up displays, CapSense switches, ADAS, and vehicle control units, and software-defined vehicle control units. We are delighted by the overwhelmingly positive response received from customers, government officials who visited our stall, including some of our investors and analysts. Thank you. Moving on to financial and operational performance for Q3, 9-month FY25. You can refer to slide number 8 and 9. Uno Minda delivered yet another quarter of strong financial performance, outperforming industry. The group revenues for the quarter grew by 14% to 5,056 crores, whereas growth is more pronounced in consolidated revenue, which grew by 19% year-on-year to 4,184 crores, driven by broad-based growth across multiple product lines and further supported by consolidation of Minda Westport and Minda Onkyo in the current financial year. Notably, the lighting, alloy wheel, switches, EV components, sensors, and controller segments exhibited strong performance. EBITDA for the quarter reached 457 crores, reflecting a 20% year-on-year increase. EBITDA margins improved to 10.9% in comparison to 10.8% in corresponding quarter previous year. Finance costs for the quarter increased to 47 crores due to higher borrowings to fund capex. land acquisitions, and working capital. Depreciation also rose in line with capitalization of new projects. The company's share of profit from associate and joint ventures is 40 crores in Q3 in comparison to 44 crores in the corresponding quarter previous year. The share of profits of associates JV was lower primarily on account of Minda Westports and Onkyo becoming subsidiary and their profits being consolidated. Besides, all JV, namely Densotan, Roki, TRMN, TGT, TG JV entities have reported strong operating and financial performance. The tax rate for the quarter was lower due to one-time accounting of tax benefit on past losses at Kosei Minda consequent to approval of merger by NCLT. Uno Minda's profit after tax increased by 21% year-on-year to 233 crores in Q3 FY25, reflecting the overall robust financial performance. For 9 months, we have achieved consolidated revenues of rupees 12,246 crores, registering a growth of 20% on year-on-year basis. The EBITDA for the period grew by 21% to 1,347 crores. The profit after tax, which is Uno Minda's share for 9 month period, was at 677 crores as against 588 in the corresponding period, reporting a growth of 15%. Coming to the business segment-wide performance, you can refer to slide number 12. Our switching systems segment delivered outstanding performance in Q3, generating revenues of 1,045 crores and contributing 25% to our consolidated revenues. This marks a year-on-year growth of 13%, driven by increased kit value from high content, greater share of business with some customers, and a robust recovery in domestic two-wheeler segment. The two-wheeler switch business continues to thrive, supported by strong industry volumes and improved exports. Of captive capacity switches in a recently launched passenger car. The consolidation of our four-wheeler switch plant from Manesar to Farrukhnagar is progressing as planned and is expected to be completed by Q3 FY27. Moving to lighting. Our lighting business remains a key growth driver, significantly contributing to the company's performance. In Q3 FY25, the segment generated impressive revenues of 982 crores, marking a 15% year-on-year growth and accounting for 24% of consolidated revenues. This quarter also saw the lighting business achieve its higher-ever quarterly revenues, driven by strong growth in both the domestic four-wheeler and two-wheeler lighting business to OEMs. During the quarter, we commissioned our new four-wheeler lighting plant at Khed, starting supplies of pixelated digital tail lamps for a recently launched passenger car. This innovative product has set new benchmarks in the Indian lighting industry, receiving rave reviews from customers. As announced last quarter, the implementation of our expansion project in Indonesia has begun and is expected to be commissioned in phases starting from Q4 FY26. Moving to casting business, the business showcased robust performance in Q3 FY25, generating revenues of 768 crores and contributing 18% to consolidated revenues. This includes rupees 408 crores from four-wheeler alloy wheel segment and 223 crores from the two-wheeler alloy wheel segment, and the remainder from the die casting business. The casting business experienced a 13% year-on-year growth led by the two-wheeler alloy wheel segment, thanks to the ramp-up of the enhanced capacity added last year. Both the two-wheeler and four-wheeler alloy segments have witnessed substantial growth, supported by capacity expansion initiatives. We are expanding our four-wheeler alloy wheel facility in Bawal by an additional 30K capacity, scheduled for commissioning in Q4 FY25. Additionally, the construction of a new greenfield plant at IMT Kharkhoda with a capacity of 120K wheels per month and a 2 million alloy wheel plant for the two-wheeler segment at Supa, Maharashtra is progressing as planned. Our aluminum die casting business has grown approximately 200 crores from 200 crores in FY21 to over 500 crore now. Starting with engine covers and other body casting products, we have expanded to applications in the seating business and electric vehicles for battery housing and chargers. New opportunities are emerging, requiring us to increase our capacity. Consequently, the board has approved a capex of 72 crores for the expansion of the aluminum die casting plant in Hosur from 11,000 tons per annum to 15,000 metric tons per annum. The enhanced capacity is expected to commence in phases from Q4 FY26. Moving to seating business, it generated revenues of 273 crores in revenue during Q3 FY25, contributing 7% to consolidated revenues. While domestic business demonstrated steady growth, the export segment faced headwinds due to a downturn in the European market, particularly impacting one of our key customers. Overall export for seating year-on-year is lower by around 18%. During the quarter, we commenced supplies of pneumatic suspended seats to a domestic OEM. Additionally, we secured a substantial export order from a new customer that is expected to bolster our export growth in the coming quarters. As we progress into the subsequent quarter, we anticipate boost in revenues from a ramp-up of volumes of a newly added OEM customer, driven by 4 new model launches by them, increased volumes from e-two-wheeler OEMs, and the commencement of supply of pneumatic suspended seat. Therefore, we remain confident in the growth potential of our seating business. Moving to acoustics business, the segment generated revenues of around 184 crores for the quarter, representing a stable 4% contribution to our consolidated revenues. While India acoustic business remains stable, our European subsidiary Clark & Horn was adversely impacted by downward trend in the European auto industry. Moving to other product businesses, the segment achieved revenues of 933 crores for the quarter, contributing 20% to the overall top line. Of this, almost 150 crores came from controllers, around 209 from sensors and ADAS, 119 crores from blow molding products, 136 crores from Minda Industries, and 123 crores from the ESPL. Most of the business under the others category are performing exceptionally well. Our alternate fuel system business continues to grow, reaching new heights every quarter, with many OEMs focusing on increasing their presence and volume in the CNG segment. The controller business was supported by strong volumes for off-board chargers for E3 sensors, and our diverse sensor offerings are driving growth of our sensors and ADAS business. Following our large order win for 7.2 kilowatt EVSE from Japanese OEM last quarter, we have secured another order for 3.3 kilowatt for their EV PV model. Our European engineering service business under Creac GmbH has been working on groundbreaking innovative technologies. In yet another milestone, they have won an order for engineering services for heads-up displays and sunroof illumination systems. Moving to electric vehicles, you can refer to slide number 16 and 17. Revenues from EV two-wheeler OEMs was 238 crore in quarter as against 228 in the last quarter and 164 in the corresponding quarter last year. During the quarter, we started supplies of 500 watt off-board chargers and 950 watt on-board chargers. With SOP of multiple orders lined up in the next 3 to 6 months, outlook for e-two-wheeler specific component business continues to be very promising. Besides e-two-wheeler, we have also been supplying components to e-three-wheeler and e-four-wheeler. Our revenues from e-three-wheeler is around 74 crores, primarily comprising of EV specific components. Supplies to e-four-wheeler mainly comprises of our existing and traditional products. Moving to aftermarket and industrial revenues, you can refer to slide number 14, please. In terms of our revenue pie for the quarter ended December 24, OE business accounted for 92% and aftermarket business at around 8%. Our aftermarket division revenues have grown by 17% to 219 crores in Q3 in comparison to 273 crores in corresponding quarter last year. Our increased focus on marketing and distribution for aftermarket products is reaping benefits. Our international sales represent approximately 11% of revenues. Though exports was slightly better than last quarter, they are still down from the peak. As highlighted last quarter, due to lower industry volumes in EU and US, our international sales continue to be negatively impacted on account of lower exports and lower sales in European subsidiaries. International sales revenues share is also decreasing as our domestic business takes higher share due to more pronounced growth. I'm happy to inform the board has also approved and declared interim dividend of 0.75 per share, which is 37.5% of face value, reflecting a commitment from the company to return value to shareholders on a consistent basis. The interim dividend for FY25 is over 15% higher as compared to last year's interim dividend. Moving to cash flow and debt levels, our net debt as of December 24 was at 1964 crores compared to 1319 crores as on March 31, 24. The net debt has increased on account of expansion capex as well as expenditure for land bank at Kharkhoda Hosur and Bawal of around 340 crores. The total capital expenditure, including the land bank for the 9-month period, was 1,324 crores. While sustaining and growth capex has been financed from business cash flows, the capital expenditure primarily on land bank and increased working capital requirement has resulted in incremental debt. Our net debt to equity as at 31st December stands healthy at 0.34. We have achieved a return on capital employed of 18.6% basis analyzing profits of 9 months FY25. Kindly note that the capital employed considered for calculation does include the capex for land bank as well as CWIP, which is currently not generating any returns. ROCE would be even higher if we exclude these non-deployed assets. Moving to strategic business update, we have received the final NCLT order for merger of KOSAI JV entities with Uno Minda Limited. Consequent to the order, all three KOSAI JV entities, namely Minda KOSAI Aluminum Wheel Private Limited, KOSAI Minda Aluminum Company Private Limited, and KOSAI Minda Mold Private Limited, has been merged with Uno Minda Limited with effect from 1st of April 23. The merger is expected to result in significant synergies in four-wheeler alloy wheel business with removal of various duplicate administrative costs of maintaining three different legal entities. Moving forward, we remain very optimistic on medium to long-term outlook of domestic auto industry. Indian automotive industry is on a path of rapid evolution driven by innovation, sustainability, and a favorable economic environment. Our company has rightly positioned itself by continuous investment in R&D, capacities, and key resources like land and people to seize the potential growth opportunities. With our existing diversified product portfolio, new product and technologies, we are confident of sustained outperformance over long term. With this, I would like to now open up the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Chandramouli Muthiah from Goldman Sachs. Please go ahead.
Hi, good evening, and thank you for taking my questions. My first question is just related to the comments that you made on fast-tracking some capacity expansion at your Hosur plant, and I think you also mentioned that there is some new opportunity that's emerging. So just want to understand what the nature of the opportunity is, and also if it has anything to do with some of these electric SUV launches that we've seen more recently at the Auto Expo. Second question is just around the budget related tax savings that large part of the tax filing community might get over the next year. What your views are initially on what that could do to production run rates at your two-wheeler and four-wheeler customers. And the third question is just on your capacity expansion over the next 2 years, how we should think about startup costs around that capacity expansion, and if there's any indication that you'd like to give around what the margin ranges for the business could be as a result.
Yeah, thanks, Chandru. So moving to your questions, starting from first. About the Hosur plant expansion. So this we have a casting plant, as I said, in Hosur, where we manufacture both traditional products for two-wheelers like the engine cover or some aluminum casting parts, etc. Plus, we also manufacture the parts for EV like battery housing and products for seating, etc. So that business has been doing phenomenally well. So until now, we have been expanding capacity in the premises and behind building whatever small expansions possible. But now we have reached a situation where we need to significantly increase the capacity from almost 10,000 tons to 50,000 tons. And this is primarily for all the existing products. There is no new product per se. So you have EV products also, you have non-EV products also, which this business will be catering to. And that is why we are in this year, we will be expanding this capacity. So that's what the nature of opportunity are. So basically, it's existing products, both EV and traditional segment. In terms of budget tax saving, you said what is our view on production run rate for two-wheeler and PV. So as I said, we are definitely very, very optimistic because at the end of the day, it will put almost 1 lakh crore of money in the taxpayers' hands next year because it's a very, very big amount. And we do firmly believe that there will be a positive friction of this on a lot of industries, maybe consumer-driven, etc. And that's what the government intention is, to put more money in hands of the end consumer, which is expected to drive the demand. So from that, we also expect that mobility being one of the key aspect of today's life, because it is not only what we always say about food, water, and shelter. Mobility also is one of the key aspect because while the cities continue to grow, the infrastructure in terms of public transport is not maybe seemingly growing up with that pace. So the demand for mobility is becoming very, very of an essence. So considering all those aspects, we do hope and expect that this 1 lakh crore of annual money which is coming in people's hands, good quantum should come to the automotive industry and hence should have positive friction on the two-wheeler and PV segment both. In terms of capital expansion for next 2 years, we know that today we have 12 projects which are undergoing expansion. Last quarter it was 13. We added 14 and 2 have been commissioned. So 12 projects are under expansion, and we might have something as we move forward. Given that we have been adding land for our future expansions, and a lot of businesses are growing very well. So they will definitely need at some point bigger facilities. So for that, we are gearing up in terms of the core infrastructure, be it land or other resources, in terms of people development, etc. We have been working in totality. You also asked in terms of startup costs. Yes, there is going to be a startup cost which is there because all the projects which the board approves, as we have been discussing, we look at third full year of production as a target for our returns or our target returns. So in first year, it's maybe part year, and second year is normally you tend to have all the costs which are incurred and not the profits. So somewhere it will be negative or zero. So those costs are baked into our assumptions, and this year we have guided for our EBITDA margin range of 11% plus minus 50 basis points, and the guidance factors in that startup cost as well. Moving forward to next year, maybe I will be better placed to answer to this question, what that range will be next year when we discuss our Q4 numbers. I think that was your question, last question on the margin range. So I hope I have addressed all your questions.
Got it. That's helpful. And just if you could repeat the numbers that you mentioned on sensor controller, ADAS, blow molding, FRIWO. I think we couldn't catch all those numbers. So if you could just repeat that once, I think that's just the one clarification I had.
Oh, okay. So you wanted the split of that others?
Correct.
So of the 933 crores, controllers is roughly 150 crore. Sensors and ADAS is roughly 209 crores. Blow molding is 119. Our CNG business is 136, and our JV with FRIWO, which is UMESPL, is 123.
Got it. That's very helpful. Thank you very much, and all the best.
Thanks, Chandru.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the parties in the conference, please restrict your questions to 2 each. If you have any follow-up questions, please rejoin the queue. The next question comes from the line of Aditya Jawar from Investec. Please go ahead.
Hi, thank you for the opportunity. Congratulations reporting solid growth despite a weak PV and CV production. My first question is on the four-wheeler charger business. So what I understand is that earlier we had one Japanese OEM as a customer, and we added one more customer. If you can help us understand how is the ramp-up plan here, how are the margins in this product line as compared to company average? If you can talk a little bit about the new growth avenue that we're looking for in chargers.
Mm-hmm.
That's the first question. If you can take this.
Yeah, second one.
Yeah. So second is on, Europe. So you mentioned that, the outlook is not that great. So if you think about from the next, 3 to 6 months perspective, are you seeing, any line of sight of improvement? Are there any OEM specific issues that you are facing, or overall you are sensing that across OEMs, the demand outlook for the next 3 to 6 months seems to be on the weak side? That is the second question.
Right. So thanks, Aditya. Thanks for the compliments. In terms of four-wheeler charger business for EVSE, last quarter we received one business and this quarter we received another business. So this is both are for the Japanese OEMs. And in terms of ramp up, obviously they will be linked to the vehicle SOP and the vehicle volumes in terms of how do we ramp up. So we know that our production is straight mirroring the OE volumes. So from that perspective, we will be ramping up as and when whatever our customer demands. In terms of margin versus company average margin, initially we do expect these margins to remain lower until they reach some better threshold. But what good thing we have done is rather than putting these products into a totally new business, we are doing this as part of our controller business. So from that perspective, it will help us spread out our fixed cost efficiently and make sure that even though it's a lower margin, we have some positive contribution from these products to our financials. And moving to your Europe question, whether it's next 3 to 2 months are we seeing an improvement? It's very difficult, Aditya. As of now, things are not significantly better. In fact, they are what they were last month. And we are keeping ourselves prepared for maybe a bit longer hiatus in terms of the challenge what we have, so that we are preparing ourselves to those lower volumes and seeing how we can bring down the break-even points in those regions, because as of now it looks difficult to visualize whether we'll have significant improvement in 6 months of time frame. Any OEM specific issues is very difficult, but one thing which is visible is that, and I think we have been reading in a lot of other coverages as well, that the very, very high-end vehicles, the demand seems to be not that impacted as we see in the low-end and mid-segment. That's what the current visibility is in terms of our revenue split as well.
Yeah, that's quite helpful. My next question is that on the land bank, out of the 1324 crores we have spent 9 months, how much we have spent on land bank, and what is the thought process on this capex going ahead?
So of the sorry, what is it? One was of 1324. How much is land? Other point was?
No. So yeah. So in 9 months, the capex that we have incurred, what proportion is for land bank, and what is our thought process on this subject, going ahead?
Right. So of 1324 crores in 9 months, we have spent roughly 350 crores in 9 months on the land. And our strategy is, as you know, to be ready, because in past we have seen 2 to 3 projects where we have faced significant delays in land acquisition, and eventually we delayed constructing our plant and had impacted directly to our volumes. So there are 2 3 advantages. One, definitely, once you have the land, we need to be closer to our customers. So to get a large land is always difficult. So earlier, and you would have visited some of our plant as well, and a lot of the people on the call, that they are spread out at various places. Now, when we buy a big block, it also helps us in consolidation in a way that we can have our own industrial park. We can have commonality of services like your security, like your canteen, like your a lot of other infrastructure which you need for that setup. So you bring synergies. Another advantage is when you talk of large investment, you also get that support from the government in terms of maybe better support in terms of approvals, clearances, incentives. There are a lot of advantages which come because you are looking at that scale. And last is that in terms of availability of resources, also our people. Once we are closer to the cities in the area we are looking land, the availability of talent also is there. So there are multiple things we do. Yes, in short term it is a drain, but as you would have noticed, the land which we have bought in Khed of almost 83 acres, almost 20 acres. We have already put a plant on for four-wheeler lighting business. Of around 95 acres we have bought in Karkoda, roughly 20 acres is allocated to our four-wheeler alloy plant where construction is going on. At Hosur, we are in process of buying this land, and part of the land is allocated for future growth of a couple of businesses which operate in that region. So the whole idea is that we are prepared for the growth in the medium term where we will not need not look after for land.
Sure, that's helpful. Now,